Welcome to the What Does It Mean podcast. I'm Lindsey Bell. My co-host Chris Versace is out today, but we've got a treat for you. We've got Rob Thummel, senior portfolio manager at Tortoise Capital. He manages $9.6 billion in capital, including a 4-star rated Tortoise Energy Infrastructure or Turtle Fund, which he's going to tell us about. And I know energy has been not one of the most exciting sectors to be invested in over the last several years, but Rob's going to make it more exciting for us in this episode of What Does It Mean? Because he's going to talk about all the different opportunities that are there and what makes this sector exciting now. So please stay tuned, tune in with us. We'll be right back after this break. All right, welcome back, everybody. Like I mentioned, we've got Rob Thummel here, senior portfolio manager at Tortoise Capital, and we are so excited to talk to him about the energy space right now. What a time to be here. Rob, welcome to the show.
Thanks for having me.
Of course. Well, I want to start big picture here with you about the energy sector in general. When I look at it from an S&P 500 perspective, it's fallen dramatically since everything's fallen dramatically since February 19th. But we're looking at a deeper decline than the overall market for the energy sector. Year to date, it's done better, though. It's fallen in line with the market, at least through the recording of this. How do you see the energy market? I know you've got lofty expectations for 2025. How do you see the energy market turning itself around?
Sure, Lindsay. So yeah, if you look back and say, well, what's the energy market, how's it done? And why has it gone down most recently? Oil prices have fallen, right? So oil prices have fallen more so because there was concern that we're going to have some political uncertainties that are going to cause a recession. And energy is pretty much tracks, in terms of energy demand, it pretty much tracks with the GDP and GDP growth. And so if we're going to have slower GDP growth or even a recession, that could have a negative impact or perceived negative impact on the energy sector. Now, I would say you got to kind of zoom back out of that and realize that that energy demand does typically go up. It's gone up, I think, 41 out of the last 42 years, something just crazy like that. So ultimately, energy demand usually recovers, but in the short term, you have these short-term blips. Now, you look across the energy sector, though, oil and gas stocks in the energy sector have actually traded off, but energy infrastructure stocks actually have held in and actually outperformed the sector. We can talk a little bit more about that if you'd want and why, but a lot of that reason is because there's not as much commodity price sensitivity in the energy infrastructure sector relative to the broader oil and gas sector.
Yeah, no, I think we're definitely going to dig into that. But let's stay at that high level for a couple more minutes. I want to talk about the supply versus demand story because you're absolutely right. It's the price of oil that drives the sector overall. Primarily, we've got, WTI under, $68 a barrel or $70 a barrel. It's a supply and demand story. And like you said, when we think about AI, right, when we think about the energy needed to drive the AI story, well, the demand should be there, right? And then from a supply perspective, OPEC is, back and forth. I think they're back on with the supply situation. But offsetting some of this is the demand, the economic demand, like you said. What's happening in China, what's happening here in the US, and then from a geopolitical perspective too, that all plays into the game. So from a supply and demand perspective, what's going to be the driver of, say, the energy sector in the next 3 to 6 months versus the next 9 to 12 months?
Yeah, no, that's a very good question. So the energy sector in general. So let's just talk about oil. So when you think about energy sector, most people gravitate to exactly what you just said. They think about oil prices, gasoline prices, right? And so they look at supply and demand, and you say, okay, well, oil demand goes up about 1 million barrels a year. It's been plus or minus that, or not plus or minus, been plus or minus several hundred thousand for a while of 1 million barrels a year for quite a while, except for obviously 2000 and the financial crisis as well as COVID. But generally speaking, the supply in the U.S. has been growing. Supply internationally has been falling. Now we're going to bring oil supply back from OPEC. The markets, maybe that oversaturates the market. We have too much oil supply. That's caused the price to fall. And as we all know, that I think the president and others want the price to come down as well, so that can curb inflation. However, what we think, and we'll see what happens over the next 3 to 6 months, but what we think longer term, that the energy sector is being redefined by what you mentioned is AI. And what AI is going to do is actually boost the demand for natural gas. So the future of energy is less about oil and it's more about the demand for natural gas because natural gas is the primary fuel source to generate electricity. And as you all and everyone knows, we need a lot more electricity to basically power all of these data centers that are going to generate all of this AI demand in the future. So from our perspective, we're looking more at what's going to happen with natural gas, less what's going to happen with oil, really to direct the sector going forward.
Well, so when you think about natural gas, you look at natural gas's prices, they've been on a tear, right? The opposite direction of oil prices. And so everybody is anticipating this AI revolution. The question is, what inning are we in? I think most people think we're in early innings, especially when you think of it from an infrastructure perspective. Is there still opportunity from an energy infrastructure perspective to get into these investments now, or have they been overpriced because everybody knows that's where you should go? I think I saw a stat that over $2 trillion has already been invested in the energy transfer.
Yeah. So what I think is going to happen is the answer to short answer to your question is no. We still think that we're still really in the early innings on the energy infrastructure side, right? So there is no AI without energy infrastructure, and so like I said, there's no AI without EI, and this is why is because the data centers need electricity, and electricity that's reliable, that's available 24 hours a day, 7 days a week. What's the best fuel supply to provide that? It's natural gas. But so you need the natural gas from the producers, but then you need even more importantly the energy infrastructure, the pipeline network. We've got the largest pipeline network in the world here in the U.S., and almost all those pipelines are owned by publicly traded entities. We can all invest in them, and so you need that infrastructure network to move the natural gas to generate the electricity. That really hasn't started much. We haven't seen much volume. We haven't seen many new projects. We just started to hear some. Williams companies announced one recently. Energy Transfer announced one recently. So we're just getting started there. That said, the energy infrastructure sector still trades from a valuation perspective at a discount to where it's traded at historically. So when you look at the energy infrastructure sector, you can get a 5% dividend yield. In some cases, even a little higher than that. You can get 5 to 7% growth in that dividend, which is pretty good. A couple percent buyback. You can easily get yourself to a market return that's above and beyond kind of the historical long-term average of 10% from the broad market. And then you factor into that, we still think that really the essential nature of these assets, the economic moats that these energy infrastructure assets really can command even higher multiples. So you get a little multiple expansion. There's still a lot of room here, we think, for really good returns from this sector.
Okay, so you're very excited about this sector. I want you to share some names too, but also it's an interesting topic to talk about right now, given the volatility in the markets. And from my perspective as a broader market strategist, what I always look at is in periods of like this, you've got to stay invested. It's not about getting out because some of the biggest up days are usually followed by the biggest down days. And so if you're trying to time the market, you end up losing out on the longer run. And this is an interesting sector, again, with the dividends, with the buybacks, and even you're saying the valuations are still attractive right now. This could be a sector that, not that it's immune from a downside market where everything is moving down, but there seems to be more opportunity here. So what are you investing in, or are you invested in? Are you buying here? Are you waiting for lower levels? Give us some names.
Yeah, so we have a mutual fund, the Tortoise Energy Infrastructure. It's an open-end mutual fund, and so some of our bigger names and positions in there are companies like Williams that I mentioned earlier. So Williams, it's say, well, Williams and Companies. What do you know about Williams and Companies? Well, it's one of the largest natural gas pipeline infrastructure networks really in the U.S. It owns some of the most strategic pipelines. These pipelines run through multiple states. I think it's probably 10 states in one particular case for their pipeline. So just think about that. You can't rebuild these assets. That's why I would say the companies like Williams and Energy Infrastructure have these big economic moats because you cannot replicate these assets. Well, it's going to be really expensive and take a long, long time to do that. So they're like companies like that where their primary business is natural gas infrastructure, where they have large diversified pipeline base. And so that's a company like Williams. And as I mentioned, they just announced a $1.6 billion new pipeline that they're actually that's going to support new data center development. And so they're going to do what this called behind the meter. And that's a technical term, but effectively all it means is they're going to be actively involved in the construction of pipelines to help really increase the amount of data centers and the amount of electricity that's needed for these data centers going forward. So that's one example.
Well, that's a great example. Talk to me too about we haven't talked yet about President Trump and his energy policy and how that's going to impact your investment in this space and how you look at the traditional energy companies versus the natural gas companies versus the infrastructure companies and so on and so forth. What's the most important aspect of the Trump policies? What's the timing? What's your anticipation and how it's going to be reflected in these stocks if it's not already
Yeah, so I
reflected?
Yeah, yeah. Well, and I don't think it is, and you raised a good point. So I think energy dominance is kind of the key theme of
Yeah.
President Trump and the Secretary of Energy Chris Wright's policies right now. And what I mean by that is, if you think about where the U.S. sits, we're in a really really good position because the U.S. is the largest producer of oil and natural gas, and really energy in the world, but also the largest exporter of energy in the world. That's kind of we've got a that's a kind of an area that really is. With where we weren't several years ago, and now we are the largest exporter. We used to be a big importer. Now we're the largest exporter in the world. So a company like Cheniere Energy that exports liquefied natural gas. So the LNG, liquefied natural gas export trade has become its own industry. Today, the U.S. is the largest LNG exporter in the world. We think that that's part of the policy is to expand LNG exports even more. So a company like Cheniere who's really the best way in the market to play a pure play LNG exporter is an example of a way investors can get exposure to that growing theme. We think if you look at a company like Cheniere, it's going to grow its EBITDA next year 10% a year. It's going to grow its dividend at least 10% next year. It's going to buy back a decent amount of its share with its excess cash flows, pay you a little bit of a dividend. So it's got a lot of those characteristics investors are looking for, but it's in an area that's really going to be supported not only just fundamentally domestically, but also globally as well.
Well, let's talk about the risks to the sector too. I could feel your energy about this, and I love it, and it's really, really amazing. But the tariffs, how do they play into it? We said, like I saw today that Ontario is raising electricity prices by 25% for Minnesota, Michigan, and New York, and I know that might be more of a symbolic thing than anything because they could choose the price that they pay, or where they get it from, is what I mean. But how do tariffs play into this LNG play, to the natural gas, and just our relationship with Canada and our energy infrastructure in general?
Yeah. So the good news is from an LNG perspective, we're mostly exporting, not importing much. But to your point, it could impact things in places like China, right? China's a big importer and we export a lot of LNG to China. Is China going to reciprocate? And I think they are going to put a tariff of their own on U.S. Natural gas that's coming into the country. And will that impact demand? The good news is the U.S. That's a small piece of the U.S. LNG exports. It's probably less than 10%. It may even be less than 5% today for some companies like a Cheniere. The opposite way, though, that is another good question that you have, though, is because where the tariffs are going to impact us is the 4 million barrels a day that come in that we as the U.S. import from Canada. So who's going to pay for that? Is that going to ultimately be paid for by the Canadian producers? Is it going to be paid for by the U.S. refiners, or is it ultimately going to be paid for in the U.S. gasoline price? And so we're going to figure all of that out. From our perspective, we think it'll probably be a little bit of all of the above. The Canadian producers will probably have to have lower margins because they'll have to eat a little bit more of the tariffs, and the U.S. refiners will probably see their margins shrink just a little bit, and then ultimately gasoline prices might rise just a tad bit as well. Once again, this all depends, though, that we're talking if the duration of this tariffs is multi months or maybe even multi years, not necessarily at this short period of time that hopefully we end up with these tariffs.
I was gonna ask you, and I don't know if you have an answer to it, but I was gonna ask, what do you think the ultimate, impact is gonna be from tariffs? Like, what is gonna be the rate? What's gonna be the length of time, as at least as it relates to energy and oil
Yeah,
on
I
Canada?
think yeah. Well, and so there practically there are lots of steps that Canada can take initially. So in other words, so I think the tariffs, I think 10% now is it's less lower than what the base rate is or what the standard rate is going to be from Canada on oil in particular. But what the Canadian producers will do first is they'll export some oil outside of the U.S. so that they don't have to pay the tariff. They have a little bit of capacity there, not a lot, not 4 million barrels a day by any means, maybe a couple 100,000 barrels a day. So that they'll fill up inventory in Canada, right? So they don't have to pay the tariffs yet, and that'll take a few months. But These tariffs we probably won't see an impact of the tariffs. Oh, probably until June, July, August timeframe is what I would guess in terms of on prices. And so that could be offset. The higher price implied because of the tariffs could be offset by more inventory coming on from Saudi Arabia and other OPEC countries as well, because oil prices could fall as a result of that, even though they might rise because of the tariffs. So you've kind of got these two uh, counterbalancing measures that are in place, and we'll see it play out. Ultimately, I hope it doesn't raise the price for of gasoline to the consumer, and I don't think it's going to have a huge impact.
Yeah, I mean, I think with all of these tariffs across the board, there's so many puts and takes, and potentially, hopefully, on the other side of this tariff negotiation, which, reminder to listeners that a lot of these are negotiations at the end of the day for broader policy objectives by the Trump administration. But there's a lot of moving parts, because if we do get past this, hopefully the focus is going to return to the pro growth policies that boosted the stock market coming into the beginning of this year. Let's talk a little bit more about some of the opportunities that you see in the energy market. I know you talked about Williams. I know you talked about Cheniere. What about energy transfer? What's the opportunity there? I know it's like one of the ones that you wanted to cover.
Yeah, I do, and this is why, Lizzie, because there's a lot of investors out there. You mentioned there a lot of uncertainty. I mean, right now, maybe temporarily, but what is certain in a lot of cases, and you highlighted this, is dividend yields, and and when you can find companies that provide really solid dividend yields, that have a history of that, and can provide that certainty, I think that's an attractive place to I'm going to call it hideout, but maybe wait, invest in these areas. And energy transfer is a classic example of that. It's got a 7.5% dividend yield right now, which is pretty attractive relative to other yield oriented securities. It's going to grow that dividend 3 to 5% a year, and once again, they own a bunch of energy infrastructure assets. And they're a little more diversified. They don't just necessarily own natural gas. They own a little bit of oil, a little bit of natural gas, and a little bit more of what's called NGL, natural gas liquid. So they own a diversified set of energy infrastructure assets. Once again, huge economic moat. You can't replicate this network that Energy Transfer has built, basically, in terms of its pipeline network. It would be nearly impossible, and not cost effective by any means. So, great management team. The company's founded by Kelsey Warren, who's a CEO and a true American entrepreneur who's done really well in building up this company. And like I said, 7.5% dividend yield, 3 to 5% growth. That's a pretty good place to start in really uncertain markets, because I think that dividend is pretty certain, as well as the growth as well.
All right, so I want to just tie a bow on this. Your estimate for the energy sector to increase 12% in the calendar year 2025. Like we discussed at the very beginning, the biggest component of the energy sector is oil and gas. They have this massive weight, Exxon, Chevron, in the sector. So to me, that assumes you have to assume some increase in oil prices, or at least some something positive out of this part of the energy sector. So how do you get to 12%?
Yeah, yeah. So if you just talk about oil and gas producers, they're a 3 or 4% dividend yield. Some of these companies, though. Let's just say oil prices stay in that $60 to $80 range. Let's say, if they drop below 60, I think our estimate, at least on oil and gas producers, would change a bit, but at least temporarily. But let's just say it's $60 to $80 range. They're going to still be able to grow the dividends. They could grow the dividends, 3, 4, 5% themselves, even in that lower oil price environment. But the thing about the oil and gas producers, the Exxons, the Chevrons, and BP, they've still got a lot of excess free cash flow, Lindsey, and I think that's important. That's new to the sector, because they're not outspending their cash flow, and so they will be buying back stock. And when they buy back stock, as you know, that can then ultimately result in the price going higher. Earnings, the PE ratio is adjusted accordingly because of the lower share count, and that results in potentially higher valuation for some of these stocks as they start to buy back stock. And so that's probably the biggest driver in the $60 to $80 range that's not been there in the past. That if you look at the sector in the past, you say, oh well, what am I missing this time? Free cash flow and the ability to buy back stock. That's the biggest difference, and that can be the driver for some of this total return going forward. In addition to the yield, the dividend yield, and some growth that you get out of the sector.
And is that because the break-even price for them on oil has been reduced significantly? Has it continued to be reduced? I don't know where it is. these days.
Yeah, partially. No, that partially, but it's also because of the discipline. So you've heard about capital discipline. If you talk to or listen to energy
Yes.
producers,
Yep.
people talk about the sector. You say, well, what does that mean? Well, what it means is there's less capital spending being spent this year, and even it's really since 2020 than what was historically spent. So before 2020, a lot of excess spending that was above and beyond the operating cash flows of the company. So they didn't have any excess cash to buy back stock. They were just either raising equity or raising their debt. Since 2020, a lot of excess cash. They lowered their capital spending dramatically. And as a result of that, now what you've seen, companies have excess free cash flow that they can utilize to buy back stock in these uncertain periods. And so that's going to be in place. You might find this interesting. I think this is kind of interesting. If you go, there's a big debate on what drill baby drill means. And if you
Yes.
just look at if you say, okay, are we going to drill baby drill? Okay, that's fine. I think that's a fair point. But if you look at the capital spending of all these major big oil companies, and you compare 2025 to 2024, 2025 actually is going to be lower than 2024 if you adjust for things like acquisitions that they did in 2024. And so, so I don't know if they're going to necessarily go out and be really aggressive in their capital spending. They're going to be very disciplined, which provides that free cash flow. Now, if prices go too high, they'll drill baby drill because they don't want then nobody wants prices to go too high. But prices aren't at a level where I think they're going to go out and drill baby drill yet.
Well, that is definitely very interesting. It's going to be something to watch too, because I keep a close eye on earnings, and the energy sector double-digit negative earnings growth for 6 of the last 7 quarters. So, I mean, just by a lower
Yeah.
bar has been set, right? So there should be opportunity to exceed that. And I just, like I said, I love your enthusiasm about the sector, and I love that you think that there's opportunity here. If there was one part of the sector or one company that you could buy today, what would it be? If you could put capital to
Oh,
work.
one company buy today.
Yeah.
Oh, well, I'm biased on Cheniere because we've owned that company for a long
Okay.
time. It's got a lot of free. Here's what everybody's missing on Cheniere. In the tech sector, everybody likes to talk about annual recurring revenue. The energy sector has the same thing. We just call it fee-based cash flow. But Cheniere has an annual recurring revenue where you can know with relative certainty for several years in a row, if not decades in a row, what's their cash flow going to be per share, because it's long-term contracts with existing customers that is fee-based. It's annual recurring. It's the high-quality customer. So it's really high-quality cash flow, but the market is not rewarding it. It's trading it at a discount to the energy sector in general. And so we just think that these high-quality cash flows that the energy sector produces are really underappreciated by the market.
I think so. You don't hear about the free cash flow that often when people are talking about the energy sector. Well, I'll give you the last word. Is there anything else that we didn't discuss that you wanna cover today while you're here?
No, the only other thing I would say, Lindsay, for this is when you think about energy, you also have to think about AI, because I've been investing in the energy sector 30 years, and for the first time in my career, the energy sector and the technology sector, they're really coming together. They're intersecting. You need the energy sector for the technology, obviously for AI to work. You need obviously the technology for the AI to work as well. But energy is going to be really important. AI is going to be a long-term secular trend, and it provides this new growth avenue and this growth catalyst for the energy sector. So there's a lot of opportunities, we think, in energy because of this AI development. And we'll see where AI ultimately ends up. It's obviously not going to be. It's going to be a little choppy on its way up. But what we do know is, you've heard about the Strategic Petroleum Reserve for oil and gas. Well, the U.S. is probably going to have the Strategic Data Reserve on the technology side. And if you're going to build all these data centers for the Strategic Data Reserve, you're going to need a lot of electricity. You're going to need a lot of energy infrastructure to make all of that electricity generate. So we're excited about that side of it and see that develop as well.
I definitely think technology is breathing like a new sense of life into the energy sector and into investors in this sector. So thank you so much for your time, Rob. We're so glad you were able to join us today.
Thank you, Lindsay.
All right, there we have it. Rob Thummel. What energy did he have, right? It was amazing. I haven't been as excited about the energy sector as I am now after speaking with him. Usually in this section, we talk about what we learned. I think Rob gave us so many different interesting investing ideas, getting very specific because we hear so many people talk about investing in energy for the AI revolution. But he put a little bit of a different spin on it. He talked about the old school nature of the industry and how it's evolving itself into the new school as it connects to technology. And it really is a sector that has always been focused on dividends, but now is much more focused on cash flow, which he likened to, in some instances, as recurring revenue. So I think that he made some really interesting points about the energy sector. I'm going to take a second look. I hope you will. Again, he gave us some really great ideas. And so I hope you enjoyed the conversation as much as I did. That's going to do it for this week's show of What Does It Mean? We'll have Chris hopefully back with us next week. In the meantime, you can find me at clearnomics.com or on LinkedIn. Have a great rest of the week.